Today, we're going to talk about the stock market, right? What is it that you need to be on the lookout for so that way you don't make those mistakes that are going to end up costing you a lot of money and creating a lot of headaches. Now, before I go into the board, I want to clarify something. There's two ways to invest in the stock market. There's the long-term way and there's the short-term way. Investing in the stock market for the short term, it's going to be a topic for another episode because it's completely different from what I'm about to show you in today's video, which is all about investing for the long term. That's how I invest in the stock market. So I'm just going to create this episode to speak about my experience and the lessons learned that I've acquired over the years investing in the stock market. So before we even talk about the stock, let's just take a step back and think about what does it mean to have a stock? What is the meaning of a stock, right? And for that, what we're going to do, we're going to think of a company. So let's say this is a big corporation. We have a building right here. We have windows, a little bit of this, a little bit of that, and we have a nice door and yada, yada, right? So this is our company. Now you might be wondering, how do companies raise funds? There are multiple ways to raise funds. Sometimes, they sell their products, they have a service, but in addition to that, they do other things in order to get access to funds so they can invest it in the growth of the company, research and development, you name it. And there are multiple ways to raise funds, but today we're going to briefly talk about three. And out of the three, we're going to focus in one. So one way a company raises money is through the issuance of corporate bonds. So that is just simply a fancy way, corporate bonds, to say that they issue debt. They're issuing an IOU. So let's say, for example, you come in and you lend me some money. I'm the owner of this corporation. And then after a while, I'll just return the money to you plus interest. So think of it as some kind of a mortgage, so to speak, right? And then as you move along the list, then we have what we call stocks. And stocks is the equivalent of equity, right? And hold that thought right there. We're going to talk about that in a little bit. And then another way to raise funds, let's say, is through crowdfunding platforms. An example of them could be a company or a platform called Wefunder, or the other one could be Seed Invest, right? And so what's the difference between all of these three different strategies? Like I said, there's a lot more out there, but we're going to narrow it down to three. So when you are investing in this stage, you're investing at the very early stage of the company. The company at this point could potentially be a startup. It could be a very small business. So the pool of investors that come in and invest are narrowed down. They're a lot smaller, and you can invest smaller chunks of money, so to speak, so that you can help this company take off from the ground up and grow. Then once they get to the point where they grow big enough and they create sufficient money, then they have the opportunity to go public. And that's what they say. And that's when you hear about companies going public, when they start issuing stocks. So today, what we're going to do, we're going to talk about stocks in specific, right? So why do I say that when you own stock, you own equity? Well, it's because it's true. You are owning a piece of the company. So the way it works, let's say you have this company, this is the 100% of it. And then let's say you have the big bosses in the company and they said, hey, you know what, we're going to keep 60%. I'm just throwing a random number out there. So the 60% still belongs to the company. But then they're taking 40% of this, and this 40% becomes shares of the company. So they're taking 40% and they're dividing this into many little pieces on paper, of course, many little pieces to say, hey, we're going to sell this one fraction of our company to you so that you can own a fraction of the company yourself. Let's just make this clear. By you owning this company doesn't mean you get to manage it. You become a silent investor. Yes, you own a piece of it. So when the company is not doing so well, you also lose money. But when the company is doing great, you also gain money out of it. However, you have no say whatsoever unless you buy at least 10% of the shares, which at that point could become quite expensive. But for the most part, you don't get to have a say in it because the rules, the big bosses, are going to be in the C-suite. Now, what exactly is the C-suite? Well, that's basically the people at the very top. And that is the CEO, that's the CFO, and that's the COO. And for those who have never heard of these terms before, CEO stands for Chief Executive Officer, the CFO is the Chief Financial Officer, and then COO is the Chief Operating Officer, right? So all of these people, amongst all others that report directly up to them, are the ones responsible for deciding what to do with the money that you invested in the company. What's the number one mistake people make when investing in the stock market for the long term? Is that they fail to do their due diligence, right? So fail at their due diligence. And by the due diligence, I'm talking about the fundamental analysis, right? So what's the fundamental analysis? Is just basically what the word says. The analysis of whatever is it that's fundamental. What is this company doing? Are they planning to reinvest the gains? Are they planning to expand overseas? Is it locally? Are they planning to hire more people? Are they investing more money in research and development? You need to understand all of that. It's kind of like the equivalent of the market research when you're investing in real estate. You need to know what area you're investing in. I'm sure you've heard from HGTV that it's all about the location, location, location. It's not so much about the house, but the location. You can have the nicest house in the area, but it's located in the middle of nowhere. Guess what? You're not going to have any luck with it because nobody wants to drive an hour to get to the closest Walmart, right? So that's the same analogy applied to the stock market. So you should definitely keep that in mind. Now, mistake number 2 that people make when investing in the stock market is to always want to get short-term gains, right? Want to get short-term gains. And why do I focus so much in short-term versus long-term? Well, there's something that the IRS code refers to as capital gains, right? So what happens with capital gains is that when you have an investment and you hold it for longer than 12 months, you pay a different tax bracket as opposed to someone selling it in the short term, because that's actually taxed as ordinary income. So anything that's longer than 12 months gets a lower tax break. So whenever you wait, time is your friend in this case, longer than 12 months, you can lower your tax rate on the gains every time you sell the stock down to 0%, sometimes even 10, sometimes even 20, depending on your tax planning and your tax strategy. But if you don't do the proper planning and you're desperate to just get short-term gains, so let's say, for example, you bought stocks in January and now all of a sudden in June, you want to cash out of them because you're seeing the growth and you want to get some money out of it, and you sell it in June. Now that money is taxed at an ordinary income level, and that has the highest tax bracket out there, and that's up to 37%. So you're, working your butt up, you're doing all that research, doing the best you can to make a gain, just that when you sell it, Uncle Sam comes in and takes 37% out of your gains. Not fair, right? So that's why you have to play the time game. This is a game of time, right? And that actually takes me to my next point. Another mistake that people make is to not have established business, okay? And I know we're talking about investing in the long term and all of that stuff, but sometimes, we do this on a full-time basis. Sometimes you're at home trading on the stock market left and right because that's all you do, right? It's kind of like the equivalent of a flipper. You work and you constantly in the middle of everything, in the middle of the action, and you get it done. And just like in real estate, I have usually said that when you're investing in real estate, you should place your property on an LLC, not only for asset protection purposes, but it also because it helps you build business credit. And at the same time, it allows you to take all the deductions that a business can generally take. In the real estate example, it will be the fees paid for the property management, any maintenance costs, property taxes, the interest on your mortgage, and yada, yada. You kind of get the picture, and the depreciation, right? This is no different than when you're investing in the stock market, because you can actually set up a business. In this case, it will be an LLC, right? LLC. And when you do that, you can actually deduct home office expenses. Could be the desk, could be the chair you're using, could be the computer, could be the courses, could be the books that you're reading to, continue to enhance your knowledge in the field. So you can actually deduct all of that so that you can reduce your taxes legally in a way that you can maximize your gains while you are investing in the stock market. Another mistake that people make is to not reinvest dividends, right? So what is a dividend, you might be wondering? Well, think about it as cash flow, right? So when you buy a rental, you get cash flow every month. So with the stock market, you can actually invest in stocks that can give you dividends on a monthly basis or perhaps on a quarterly basis, maybe every 6 months, maybe yearly. It all depends on the company. And so what a lot of people don't know is that sometimes they have invested in stocks that provide them with dividends. And when they receive the dividends, they don't do anything with it. They just leave it there sitting in their brokerage account. And you don't want to do that. You actually want to go ahead and click on the option that allows you to reinvest the dividends. And what it does is that every time you get the dividends, you're reinvesting it back into the company. And you're also helping the company grow faster, and also your investments grow faster. So let's move on to the next mistake. Spending your gains in bad debt, okay? That's a very bad one. It usually has a lower entry point, which it makes it easier for people with less budget go in and start building their equity until eventually they amass a certain amount of money and they can actually use that capital that they have managed to create and invest it in real estate. And that's how you eventually wind up getting access to your very first property. So when you do that, when you take your gains and you do that, that's you investing in good debt. However, there's some people out there who don't understand that concept and they invested in bad debt. What is bad debt? Bad debt is whatever debt that requires you to work your butt off to pay it off. So using your gain and actually putting all that money away in one night, or spending it in Gucci shoes that don't necessarily create any passive income whatsoever. Now, with that, I'm not saying that you shouldn't enjoy yourself, that you shouldn't go out there and celebrate life or buy yourself a nice splurge because you have worked very hard. But there's something called timing, right? You have to wait for the right timing. When you are in growing mode, you shouldn't be spending money like that because you're taking capital away from building your future. You want to use that capital wisely so that way you can build something, and eventually once that passive income is flowing in and coming in, you could probably splurge yourself a couple of things here and there and celebrate your effort and the product of your sacrifice, right? The next mistake people make, it's always wanting to time the market so you can buy low, right? Buy low. Yes, it's true. There are a lot of people who focus on buying low. They do all the technical stuff where they look for the highest, the new high, and then the new low. That's great if that's how you're investing in the stock market. But when you're investing for the long term, your best friend is time. So you cannot afford to be waiting for the next low, the next cheapest moment, because what you want to do is just to get in as early as possible and let time help you compound everything you have been accumulating over the years. And even if there's a market correction, let that correction be waited out because you're letting time go by. So forget about trying to time everything so you can buy it with the cheapest, amount of premium possible. Forget about it. Time is your friend. The earlier you start, the better. The next mistake that people make is to fall in love. That's a heart right there. With the company. It's horrible. Why? Because your emotions are clouding you. You're not thinking straight, right? You are in love. So therefore you see everything beautiful in your eye. There's actually something very funny that I wanted to share with you. I was watching an episode of Friends a couple of weeks ago, and it was quite fun. And it was about an episode where Rachel gets to meet up with her sister. The role that was actually played by Christina Applegate. And so in that episode, the Rachel sister, it's looking into transitioning into a new career. And she decided to become a baby stylist. You cannot make stuff up, right? So, she meets up with Rachel, and Rachel is walking down the street and asking her, hey, how's the baby styling business going? And she goes and says, I don't know. I don't understand why people don't want to admit or understand that their babies are ugly. And when you come to think about it, it's like, well, parents, babies, all the babies in the world are beautiful. Every baby deserves to be in a commercial. Every baby deserves to be a Gerber baby, right? But you kind of like understand the analogy in here, right? Don't fall in love with the company. Otherwise, your judgments are going to be cloud. And if it gets to that point, you know, just take a step back. Ask yourself, why did you invest in this company in the first place? And then go over the numbers. Keep everything fact-based. Once you focus on the facts, the picture will be crystal clear.